All right, guys, welcome back to another episode of the Mogul Marathon Real Estate Podcast. I'm your host, Yannick Cudjoe-Virgil, and I'm very excited for our guest today. Our guest today is Ben Guttman. Now, Ben was born and raised in Baltimore, and Ben has toured North America for school with stops in Milwaukee, Vancouver, and New York before returning home to start his career. Armed with dual interest in marketing and helping others, he landed with a group that was purchasing all state agencies and have never looked back. And after a brief foray into copier sales, which helped hone his skills into inner workings of businesses, Ben has continued his passion for helping people with their insurance needs in the independent agency channel with North Central Insurance Agency. His three main areas of expertise are real estate, nonprofits, and cyber liability. He's been featured in multiple publications, including MHN, and currently serves on the producer licensing advisory board for Maryland Insurance Administration and the Trusted Choice Content Committee. Ben, thanks so much for being on the show today.
Thanks for having me, Yannick.
All right. So today's topic is about insurance, right? But before we really dive into the nitty gritty, give our listeners a quick 60 to 90-second insight about your story and how you got to where you are today.
Sure. So as you can see behind me, I did not make it pro like Yannick did. I did apply for the NBA draft. Unfortunately, 6'1" just wasn't going to cut it. But I still can shoot. So I grew up in Baltimore. Like most people in the insurance industry, kind of ended up in it by accident. But fell in love with it and immediately saw the value in helping people protect stuff. I mean, we literally protect whether, it's, someone's asset that is, paying for their home itself, their business that's paying all their bills and taking care of their family, all that stuff that you're protecting is really what helps people live every day and, feel like they're living a successful life. So it's kind of important, as much as no one likes talking about insurance. It's like one of those, damned if you do, damned if you don't kind of things. You kind of need to have it, but you kind of hope you never have to use it. And so the biggest thing that you can do as an agent or a broker is, really advocate for your clients. First of all, in the first place, getting it set up correctly. And then if God forbid something does happen, being able to hold their hands through the process and make sure that they get made whole again.
Absolutely. Absolutely. Totally agree. I think, as you mentioned, insurance is one of those things that nobody really wants to pay for, but you're glad that you have it, at times of, whatever goes on on your property. Right. But, given the fact that there's been a ton of disasters, I guess, as of recently in America, and we've just recently experienced the disaster that happened in Florida that wiped out a lot of property. And there's a lot of talk on how that is going to impact and change the landscape of insurance, because obviously insurance is a business too, right? And if they are paying out more than they are getting in from a premiums perspective, that's not a good business model. But I guess general high level, give our listeners a little bit of insight on the state of the insurance markets, given the disasters that are occurring in the US today.
Yeah, so you brought up Florida and obviously Surfside, with the $1 billion settlement over there, and just in general for property owners to see that was a possibility. Now, obviously, no one wants to ever think, God forbid, it would be their property, but these things happen. I was just reading an article this morning about a fire down in Carroll County, and I'm like, oh man, I know where that street is, and we have clients on that street. But you never wake up in the morning thinking it's going to be, your property. I think the best way I heard this put is, somebody, every morning when you drive to work, you see an accident on the highway, but you never expect it to be you. And that's really why you have insurance, is because no one ever expects it to be them. And when you get down to it, it's like you'd rather have it when it comes up because you can't buy it after the fact. And that's really where we are with this whole natural disaster kind of inflation, all mixing together to make this interesting hard market that we're having now, because that's really where it's at in the property space right now. I've been going back and forth on a purchase that's going on for a client, And I'm getting smacked right and left with, oh, well, we don't want this, and we're afraid about that, and we got to raise the prices because materials costs are up. I don't know if you remember, it's probably last year or 18 months ago when lumber prices went through the roof. I mean, the amount of deals and new builds and renovations that just came to a halt because the prices went up 400%.
Yeah.
Well, on the insurance end, the carrier, like you were talking about, it's a business, and they have to have enough money in the pot to pay legitimate claims. So when lumber prices go up, they got to have enough money to account for that. And that's where people, it's kind of a disconnect where they're like, oh my gosh, well, I paid, $5,000 last year. Now you're telling me it's $8,000. It's like, yes, because if the property burned down last year, $5,000 from everyone that put in would have been able to put it back up again. If we did that this year, you're going to get 3/4 of a building and no roof. So that's really where the problem is. It is a shared risk model, and therefore, there has to be enough capital in the pot to account for paying out the shared risk. To put a bad spin on it, kind of like what you're seeing when everyone made a run on the FTX disaster or a run on the banks. If everybody had a claim, God forbid, at the same time, there's got to be enough money to pay it all. And that's where natural disasters get interesting, because that's a massive amount of claims in a very condensed, concentrated space. So you have like a hurricane or, some other disaster that goes through. You're not talking about paying for one house at a time. You got hundreds of houses that are now damaged. And that's when it really gets put to the test of whether they underwrote properly and there's enough money in the bank to pay out or not.
Yeah.
Florida, for example, which of course has this horrible track record, and now we're seeing it with wildfires on the West Coast and other disasters that are happening. But Florida in general has some crazy insurance laws. And I mean, I see this in all this type of chatter and all the agent groups I'm in. I mean, where can I put this? Why is this company leaving the state? Why are they increasing this and getting rid? I mean, I was looking at a property for a client down in Texas, and just the wind coverage was more than the rest of the policy.
Wow.
And that was more than a whole policy would be on a similar sized property in Maryland. So just to give you an idea of what's happening in these states where that's happening, they have to account for these crazy disasters.
Yeah. No, thank you for that context. And obviously the disasters, as as you mentioned, is definitely having a greater impact as we continue to see more and more. And most of that probably can be contributed maybe towards global warming, and that's a different conversation for another day. But how should real estate investors really be looking at risk from a maybe a acquisition criteria perspective, right? If you're looking for deals that might fit your specific criteria, but you might be going into a market where disasters are happening, or insurance premiums are can be challenging. How should investors kind of approach maybe their acquisition criteria from that perspective, given the fact that insurance coverages might change or the rules might change, etc.
Yeah, I mean, I wouldn't particularly buy anything beachfront in Florida right now, but there are a lot of guys that are, having success in places like Texas is blowing up and the Carolinas are blowing up. I just think you got to be a little bit further inland. Now, there are carriers that have taken advantage of the fact that a lot of companies don't want that business, and they're willing to basically say, "We'll do it for X amount of dollars," and it's a trade-off. High risk, high reward. People want a waterfront view. So you're going to get more money for rents for those buildings, but your insurance bill is going to be higher and your risk factor is going to be higher. It's all balancing that level of risk that you're willing to take as an investor. And it's not just on the insurance angle. With anything, people that go into, a distressed neighborhood and build it up, there's a lot more bang for your buck if it works. But if the block doesn't materialize, you just threw a bunch of money at something that, no one's going to want to buy. And that's why you always see like guys that want to be the second or third guy on the block, not the first guy. Someone's got to jump into the water before someone's willing to do it. And that's really, if you're going to be in one of those higher risk areas, you got to account for that in your underwriting. Because you can be sure the insurance carrier is going to account for the fact where, location in their underwriting. So there is that high risk, high reward kind of deal. People want to be beachfront. People want to be, in California, with the coast out there. All these things are great. You want to be in the woods. You want to be in the mountains, but they come with their own risk profiles. and don't assume it's going to be like some, Main Street America investment.
Yeah, no, that's a good point. That's a good point. And as of recently, to your point of going into areas that might have higher risk because you're getting in early, but the insurance implications can be something that investors might not know about, right? I've
Yep.
had policies before where I had insurance advisor send me a message saying, "Hey, the underwriter or whoever's behind the scenes Googled your property." And it's still brought it up. Hey, what's going
Yeah.
on here, right? I didn't really think that underwriters or insurance companies actually did that.
Yeah, so I mean, I was out this morning before this call taking pictures of a property for underwriting because, for this company, they write a lot of my properties that people have rehabbed in Baltimore City, but they want updated pictures because you can Photoshop, all the Google Map stuff around, or you can, try and make it look pretty, but, based on the area and based on the fact that, hey, 6 months ago, this house was a board up and now you're renting it out and you got a tenant in there, we want to know what it actually looks like. And we want to know if the house next door is a vacant that's falling over. Because guess what happens? That catches on fire, God forbid. Now our property is damaged and we're on the hook because you're never going to find the guy who owns that. So that definitely is an issue. Also, when you go in and you start rehabbing stuff, you run into builder's risk kind of deal where there are different liability exposures. With a regular house, someone isn't going to walk into the property and trip on something and, end up in the hospital needing tetanus and stitches and all that stuff because we have front doors that hopefully lock. When you're working on a project, you don't necessarily know what's out there. The other big factor for people that are rehabbing stuff is materials on site. So you leave a bunch of stuff there, and then some guy comes and steals all the copper out of all your stuff, and now you got to go buy new appliances, and you got to start from scratch. That's a big outlay. And I've had people who, have had either material stolen from a site, or you deal with, really, this is a lot on the vacant side, but it also happens with builder's risk, depending on how often you have a contractor in there. You deal with, things, a pipe burst, right? Right now, I mean, now it's actually nice out, but last weekend when it was frigid here, even occupied homes that had the heat on low were having issues. And we've had claims all week with people who have burst pipes and this thing's flooding. The synagogue that I started on the board of, we had a leak in our roof and we just had it redone, but it was right on a seam. And now we got to deal with it. And it's another $3,000 to fix that.
Yeah. No,
so
it's yeah.
So that type of stuff, that figures into the underwriting. And they're like, well, I pay, $1,500 for my homeowners. Why is this so expensive? It doesn't have any nice stuff on the inside. It's like, yeah, but you're putting the whole property at risk because if you don't come back for a week and, a pipe burst, it's a total loss. That place is gone. It's going to start getting mold and deteriorating and who knows what goes on with it. And you got to start from scratch, and then you got to replace the floors and you got to, tear everything apart to dry it out. It becomes a whole mess. Whereas an occupied structure wouldn't necessarily have that because you'd hear running water.
So let's transpose that in the context of a multifamily property, right? You brought up the point of builder's risk, and a lot of our listeners are interested in getting into the multifamily space or have already been in the multifamily space. Are you advising your clients to have builder's risk policies on value add projects? And maybe we can talk about, maybe what some items in the policy may cover, maybe from a building perspective, building coverage or general liability. But I think there's not a lot of education out there that helps investors get educated on policies, right? It's one of those things where, as you get more and more experience, you might get a little bit more astute in how you place your policies on your properties. But certainly if you're raising capital for deals and it's your first deal, you absolutely have to know, right? We know what policies that you should put on your property. Give us a little bit context on that.
Yeah, so that is the biggest paradox of insurance, at least for me. And we see this all the time with people who want to move a car or a building after they've had a claim or an accident. It's like, well, now we know that it's a problem. So now it's going to be more expensive. So I feel like investors that are learning on the fly, a lot of these guys are big risk, big reward guys, especially flippers. And it's like, they run 100 miles an hour and they just want to get it done because they see that paycheck at the end of the tunnel and they have no idea what they're getting themselves into. And you see it all the time with guys who oh, we had this great project. We're going to be in out in 3 weeks. And then they find lead or then they find, who knows what other structural issue. And then like all of a sudden this great, $50,000 payday becomes a money pit that you hope to break even on, or you sell at a loss and just chalk it up to a learning curve. So it's the same thing with insurance. The guys who know how to use a policy, it's either because they talked to someone else who had a bad experience, or had a claim that got paid. It's like, you better have this because if I didn't, I would have lost my pants. Or they learn through experience, and then it's like when you're filling out those apps, and it's like, so have you had any claims in the past 3 years? It's like, oh shoot, they're going to deny me here, or they're going to up my premium because they know I'm risky. So that's really, to your point, if you don't find out about it beforehand from someone who has experience or someone who, was in the field, you're not going to know what to put on there. And that's part of the problem with this whole online shopping thing, is everyone just like, yeah, you could do it yourself and it'll take you a couple minutes. You don't have to talk to a human being. It's great. We all became very good at that during COVID. There's no talking to people. We just like do things on our computers and whatever, just kind of hide in our hole and order stuff from Amazon. But the flip side of that is no one's telling you what you're forgetting or what you took off to save a couple bucks is really what's most likely to happen. I mean, that's what we see the most is, people cut stuff because, hey, look, everybody's got to save money to either put back in the deal or so they can pay their bills or whatever it is. So everyone's look, I tell people all the time, I am the biggest bargain shopper out there, but not on the stuff that's important. So like everyone has their stuff that they're willing to overpay for. I just saw someone post on LinkedIn, yesterday about they're willing to pay 3 times as much for certain things because that's their thing. They like it, high quality. You're not going to get a good steak at, a Family Dollar price. It's just not going to happen. If you want to say that you have steak for dinner and go to Family Dollar and buy some cheap ones, you have something called steak. But it's not going to be like going to, a gourmet place and, them coming out there and carving it at the table and all that.
Yeah. So give us, if let's say I'm buying a 50-unit property, right?
Okay.
I'm doing a value add renovation on it. How should I be looking at maybe putting insurance on the property? I know one of the things that I do specifically when I'm looking at properties, because I'm, my acquisition criteria is pretty much in the C plus, B minus space. And that might be, 1960s product, 1950s where I live, and, my markets and ordinance and law is something that's super important, right? If the building burns down and, we have to bring it up to code, the code in 1960 is completely different to 2022. So, how can investors, maybe put a policy on a just, a multifamily, product, today?
Yeah. So, I mean, on a regular BOP, which is a business owner's policy, where you kind of package some different coverages together. And again, not every single one is the same. So it's like, oh, well, I have a BOP from company A and a BOP from company B. That's like saying that you have a Toyota and a Mercedes. It's like they're both cars. They both have 4 doors, but you kind of got to get under the hood and see what's going on there. So a typical business owner's policy is going to have the general liability portion and it's going to have the property portion. So you got to cover yourself. General liability, we generally talk about, your slip and fall coverage. Someone gets hurt at the property and sues you. That's going to defend you and hopefully settle with them or convince them that they don't want to fight with you, depending on what the insurance company decides there. They may think like, okay, well, you have cameras on the property and we know that this person put the banana peel there before they then slipped. So we can prove that wrong in court and not have to deal with it. But usually it's going to, if someone makes a claim against you, they're going to, look into it, represent you and settle. And get you off the hook. So that's the general liability portion. And then the property portion is going to cover the actual structure of the building. Now, when you get into multifamily stuff, you have an advantage and a disadvantage. So the good part is usually it's just one roof that you got to worry about, as opposed to if you'd have 50 single family properties. But the disadvantage is that you have all these tenants in there. And the reality is when you have 50 different people with 50 different, standards of living, lifestyles, what's going on, the insurance company is not going to investigate, each person in there, but they're, based on, neighborhood stuff. And they know that the building next door had, a bunch of robberies, or they know that the building down the block had a fire, or, all these different risk factors. That's going to figure in because they are basing it based on their experience in that area. And that's where you get into really, some people are like, well, why is there such a difference in price between company A and company B? And it's like, well, they lost their pants in this zip code. And we see it all the time with auto insurance for sure. When you have a company that's had a bunch of bad drivers, let's say in 21216, all of a sudden 21216 go through the roof, and the other company, everyone starts shopping, and they're like, we love 21216. We've had no accidents here in the past 6 months. So that really, there's an individual company experience. There's your experience as, as a business owner. So if they see your track record and you guys do great work, that's going to help you. If you can prove that, hey, we've successfully rehabbed a building in 5 to 6 months, we turn it around, we get it leased up, and here's how we do that. That's going to be much better than the first time guy who says, hey, I got a bunch of money from my uncle and his buddies. I'm going to try and pull this off. So that's a factor as well. But back to your point about what you should be looking at. So you have the general liability portion of the policy. You have the property portion. A very important part, if you're dealing with investment real estate, is the loss of rents part, which would be on your homeowner's policy. That would be coverage D. It's still coverage D, but instead of paying for you to live somewhere while the house gets fixed, it's paying you for no one living in it. So if, God forbid, your building had a fire and you got 7 damaged units and you're losing, $1,500 of rent every month on those units while they get rehabbed, your policy is going to be paying you for that because you still have to pay your mortgage. And that's something people don't think about a lot because they're like, okay, well, I'll insure the building and they'll pay to fix it. But your building isn't paying your mortgage while there's no one living there. So you got to protect yourself against that because that cash flow is really your income, especially if you're paying out dividend checks to investors who are expecting to get money every month. You really have to have that money coming in. You brought up ordinance and law. Code is going to be a huge thing, especially if you're dealing with older buildings. I just had this with a 35 unit I'm working on right now for someone. I had an underwriter come back to me and say, we're really, in the past 2 weeks, have gotten really stuck on things that have to be 1980 or later. It's just that's just where our market is right now. And I'm like, okay, I know this one's 1969. I'm like, 1969 used to be much closer a few years ago. It feels like, like kind of like where you think like, the 90s were recently, except they were 30 something years ago. So it's that type of thing. It depends on the company. And it may also be a difference where once you get the building rehabbed, it may be much more attractive than it is, coming into it. And that's like you were talking about, buying C plus B minus properties. If you have the C plus B minus building in an A neighborhood, you're the man. And that's kind of where you want to be. You want to get in on that and spruce it up. And now it's not costing you the same as it did to put up a asset, but you're cash flowing great. So you want to protect it on that end. And that's why that ordinance and law is so important that you brought up. Because if something happens, and they come in and say, well, now you got to have sprinklers. Now you got to have, all these different things that comply with, you got to update. I'm trying to think. You got to update all the electrical in the building. You got to update, the plumbing's, old system, whatever, copper versus PVC versus. All of a sudden it becomes very expensive because you're not just replacing the 7 units that got damaged. You got to upgrade the whole building. And that becomes a very, very expensive endeavor if you don't have the coverage for it.
Yeah, no, that's really, really good points there. I think, from an insurance perspective, like I mentioned on the onset of our chat today, it's one of those things where you want to make sure that you have, but you never want to use, right? And from an investment perspective, our biggest goal should be how to minimize our risk on opportunities, right? As investors, we want to focus on the project and producing returns for our investors and executing a business plan. The last thing that we want to worry about is something insurance related, right? And I think when you approach it from a risk perspective and trying to protect your interest and your investors' interest, quite frankly, it's important to have those coverage and not necessarily go cheap on these policies, right? We already talked about ordinance of law. One issue that we had on a property that we acquired early on this year is aluminum wiring, right?
Yep.
A lot of insurance carriers don't want to insure that because of the fire hazard, the risk to that as well. So I think it's very, very important for investors to know exactly what they're getting into. And I think when you talk about due diligence and doing the the inspections and investigating the property itself, a lot of those things you get to discover a lot of those things, and you should report that to your insurance agent, right? You don't want to hide anything on these properties. You want to make sure that everything is disclosed and you're insured to the best way possible. But how are you helping maybe investors get pricing as well too when looking at properties, right? Because a lot of new investors as well think that the seller has maybe a $10,000 policy. That's going to be maybe my policy too, right? But you're actually insuring the property likely at a higher price. You never know if the current seller has other bundles or whatever the case may be that might lower their current insurance policy. Like, at what points do clients engage you, and how should they kind of estimate maybe putting in an LOI on, like, what this insurance policy might cost
Okay.
on the deal?
So that really depends. And I just want to go back a second. As someone who's doing syndications, you have to think of it as like your job. So the same way that you would spend a little bit extra to keep your job because you kind of need it, it's the same type of thing, at least in my mind, where you wouldn't get the cheapest car possible because if it doesn't start and you don't make it to work enough mornings, they're just going to say, we no longer require your services. So if you want your investors to keep investing with you, they want to see that you're being responsible with their money, and that includes removing the risk of them losing it when one of these things happens. So that was just a thought I had when you brought it up, because you can't completely eliminate risk, but the point of having insurance is that the risk is there, but we have a stack of money to fall back on if something happens. So you want to make sure that that is stacked up in your favor. And I'm sure the insurance company is happy to collect the premiums as well, but you want to stack up in your favor. So if something happens, you don't end up feeling doubly, it's adding insult to injury to have paid in and not paid for what you need the coverage for. And people are like, oh, why do I pay all this money if I don't get any? It's like, it's a contract. Just like the contract you signed when you bought the building. If you didn't read it because you were just doing it online and clicking things at 2:00 in the morning, watching Netflix, and you're just like, oh, I got to have something to give the darn lender, that's what happens. We are very much in the not reading the Apple, terms and conditions kind of mindset. And then it's like, well, they pull it out. It's like, well, you actually just signed up to give us your firstborn child, and you can no longer operate the phone between 7 and 8 p.m. and all this stuff. It's like, what do you mean? There are no rules. It's like, you clicked okay, accept. So it's the same type of thing where, from a contractual standpoint, you were dealing with a business contract that you can be sure the insurance companies have lawyers, going over it. In the same way that you want to do your due diligence on the building, you want to make sure that, your stuff is going to stand up when push comes to shove. In terms of getting kind of like the estimates, the hardest part now when things are a little bit, pushy and everyone's like, well, we want this perfect thing this way and that. Everyone used to have their magic, per door number. And then everyone yells at me that it doesn't match anymore. And I'm like, that just doesn't exist right now. Or if it does, it's definitely not the number you thought it was 10 years ago when you bought your first building. And that's really the hardest part. Sometimes I can help people out if I know the area and I have other buildings that I've insured for them, or I've insured for other investors in that area, just because I know kind of where some companies are looking. But the hard part with that also is that sometimes companies, like I was talking about, just change appetite on you. So like I have a guy right now who's renewing tomorrow, who we had to go and, completely rewrite everything. He's been with the same company for 6-7 years. And they're just like, we don't want to deal with that anymore. We got acquired by a bigger, insurance company. This was a loss leader for us. They want us to get back to doing things that are going to make them money and make sure we have enough to pay out claims. We don't want to write this high risk profile property. And I'm like, oh, great. Now I got to go find somewhere to put something for this guy who's been perfectly happy to keep it where it was. And that's really where you get into your looking at the prior owner's insurance is helpful as a clue. And I always tell people, send me the current policy. And then the first thing I look at is what their replacement cost is at. And then you realize that the last time they recalculated that was when they bought it back in 1984. And to pay for those materials and put up that building again today would cost 2 to 3 times what they have it insured for. And you're like, they're just lucky that they didn't run into an issue. And that's where you get into stuff that no one educates anyone about, which is reinsurance clauses. And so sometimes you'll see it from like a lender. They'll say, oh, we want no reinsurance, or if it's there, it has to be set up a certain way. But basically, the way a reinsurance clause works is it's a simple math problem where if at the time of a loss, the property is not insured for at least 80% of the value, you're going to get penalized on your payout because you weren't being responsible and putting the insurance company at risk. So in other words, if you have, let's just do round numbers. If you had a $10 million asset, you had it insured for $6 million, it needs to be at least 8 to be considered that you actually had the insurance company's best interest in mind. Because remember, you're two parties in a binding agreement here. So they just have a way of doing the math, and I can send it to you. I'm completely blanking on the exact. It's a decimal point, but instead of getting whatever the total amount of claim is, you lose some of that money because you're putting them under the bus. And that's what people don't think about, because everyone's like, oh yeah, just insure it for the loan amount. Well, you can get something, especially if it's being rehabbed, for a lot less than what it would cost to put that building up brand new today, especially when you get into that code stuff that you're talking about. So that really is something people don't think about. And I just had this now with this building also. They sent me, and he's calling me about it now. They sent me their underwriting and what they're buying it for and this whole thing. It's like, no lender is going to take that number. No insurance company is going to take that number. And I just got an email from an underwriter. It's like, the number that you sent on the application is smack in between where we would put it if it was on actual cash value, which is including and accounting for depreciation, which you never want. Pretty much never want. There's some people who do it because you don't have a choice, but unless you don't have a choice, never take actual cash value, because depreciation will get you when it comes to a claim.
So what should investors take instead of
it should be a replacement cost. So those are usually the two options. Well, there are three. There's replacement cost, which is the best one because that's going to put it back to new. There's agreed value, which you basically say, look, regardless of whether it goes up or not, this is what we're comfortable at. Probably because we have enough to cover the difference and we don't want to overpay. So let's say the building's worth $6.5 million. We agree to insure it at $7 million. Because, there will be some inflation and materials may go up, but we agree 7's the cap. You could do it that way depending on the carrier, or there's actual cash value, which becomes a problem when you have a 40-year-old building and there's a fire. And it's like, okay, well, how much is a 40-year-old building that you guys have, just put some paint on really worth at this point? And then it's like, instead of getting $1 million to redo it, it's like, well, here's $50. Obviously, it's not $50, but it's pennies on the dollar. The example I always give people when you're dealing with their personal stuff is like, how much is your 10-year-old couch worth today, or your jeans that you've worn 100 times? You can't go buy new clothes or new furniture if you don't insure it where it's being replaced. And that's really like, that really is something people, I hate when people send things in and they're like, you see that actual cash value clause and you're like, you realize you won't get anything if you use this policy. Like, I know it'll cost you a couple more bucks up front, but at least if God forbid something happens, you'll actually get paid, what you're losing. So that's something that we see. Although usually now most people I think most people, if they talk to other experienced investors or talk to a broker, will understand that. But sometimes it's like, on page 4 and you don't think about it and you're like, well, why is this one 15,000 and this one 10? I'm going to go with the 10 because I want to save $5,000. It's like, well, you're saving $5,000 now, but you lose $100,000 if you have a claim and you're getting, like secondhand lumber.
No, those are really good pro tips there, and that's why it's so important to have an insurance agent or someone that's advising you on these policies, because a lot of real estate investors, quite frankly, don't know the difference between actual cash value and replacement costs, right? And it's insurance, honestly, is one of those things where I think it's probably the hardest to really kind of gauge where you're going to be at when you're first looking at a property. And then, until you've actually discovered some of the things that are going on in the property and how different insurance carriers might look at it, then, maybe towards the back end and due diligence, what it would probably cost, right? Because like you mentioned, that current seller might have insured the property 30 years ago and the numbers might not have adjusted, right? Or a bunch of different factors. But I think definitely knowing who to go with, people like yourself who are very very knowledgeable in the insurance space, latching on to people is really, really important when you're trying to put these deals together.
Yeah. And the reality is, there's some brokers out there that have, snuck in on whatever page it is, broker fee. But the reality is it doesn't cost you anything to have someone who's a professional and actually deals with it on a daily basis, look at it. You can't go into a mechanic or get a plumber to come out or attorney or any of these. Well, attorneys sometimes work on contingency, but then they just take more off the back end. But you really can't get anyone else that on a daily basis is handling your issue to do stuff for free. Insurance is the one place where you can get someone, because they're obviously making a commission, but you can get someone who actually understands what they're reading and actually has the relationships with underwriters to do it, and it's not costing you anything up front, which is great. In my book, it's like, I do understand the allure of doing things online. I understand that sometimes people just don't want to talk to someone, think that it's more fun to, hey, if I click something, it's much easier than having to write it.
Yeah.
And there is a speed factor with that sometimes is great. And I get it. Like, people are up against the wall. I tell people all the time, like, look, if you needed to get something to get off the lot or to sign the paperwork, that's fine. But then come to me a week later and let's fix it.
Yeah.
Like, I've even done that for people on the personal homeowner side. There are lots of times where people are right up against the line, and I'm not going to get into the whole discussion of whether they should be buying that property or not. But their debt to income ratio is right up against the line, and I'll have the lender say, "Hey, look, can we give them a higher deductible so that the insurance pricing comes down? And the second we finish with settlement, they can put it back and pay the difference, which is probably $100 or $200. But again, you're right up against that fine line." Which gets back into ways that you can kind of lower your premiums. Is if you're not going to make a claim on a 50 unit asset for less than $10,000, and you're comfortable with that being the deductible because you're only going to do it if it's worst case scenario, having that instead of $1,000 or $5,000 or whatever it is, that will affect your premium. And that's something that we see all the time. I have investors that come and say, like, why are you offering $1,000 deductible anyway? I'm not going to make a claim on something that's $2,000, $3,000. So that really is something that people don't think about either. Is that, and you see it especially on larger properties, is like, people are starting their deductibles up at 10 and going up from there. Obviously, depending on the company, and depending on if you have a loan on it. I actually just got underwriting terms from a lender, and they're like, the deductible cannot exceed $5,000 on this property because they just don't want to deal with it. So I'm like, okay, well, we can go up to 5. But again, it all comes down to risk tolerance with deductibles. And to the insurance company, your deductible is your skin in the game. So if you're willing to put, $1,000 on the line, it's like, well, we're going to charge you more money because we're going to be paying out the other 99. If you're willing to put 10,000 on the line, they're like, hey, we'll give you a lower price because we're not responsible for the first $10,000. So you're only going to use this if it's a much larger claim.
Yeah, that's interesting. Interesting way to put that in. You're totally right. Right. It's a business, and it's like you mentioned, it's a risk sharing model to it, and definitely have to know how to put these policies together. How to understand the risk that you're willing to take on these policies as well in these properties, and make sure that you're getting some professional advice when you're doing these projects. So, a lot of our audience today might be interested in, like I mentioned, some value add opportunities as well. And I think one of the things that I wanted to touch on today is contractors is another risk element that not a lot of people really take seriously from a documentation perspective. And, for the folks who are jumping into the world of commercial real estate from residential real estate, the smaller landlords might have a looser attitude when it comes to documentation and things of that nature, as opposed to when you're jumping into larger opportunities and you're raising capital. It's really important that you have to understand that you're not doing the same, or your risk tolerance is not as loose when you're just playing with your own money compared to investors' money, right? I want to ask you a question on if you would advise, investors to have documentation sources from a payment bond perspective or performance bond perspective as well, when they're attacking these, or redeveloping these multifamily projects as well. Do you advise your clients on those contracted documentation sources and the importance of those as well?
So we do. It kind of depends on the project, and where bonds really come in much more on the contractor side is the bond is kind of the opposite of insurance. Insurance is kind of protecting, you and your asset. The bond is kind of like a third party thing where basically you're paying money in, and whoever the bondholder is going to pay out if you don't failure to perform, basically. So, you have a contractor who shows up, starts and, gets 90% of the work done, and they have this bond in place. Let's say it's $25,000 with MHIC. They're going to pay out for that because their guy left you high and dry. So it's a different relationship than insurance because there's a third party involved that's kind of holding it and holding both parties responsible. On like a regular, smaller rehab, I don't think it's necessary. I do think you should get documentation from your contractors that they're licensed. Because if the insurance company asks you, like, hey, did you have some licensed person, do these repairs, or you just had your cousin Billy do it? You want to be able to show documentation that you had someone who knew what they were doing. And I do think you should get evidence of insurance from them that they're insured. Because if they mess something up and their insurance is supposed to pay for it, why are you going to, right? If the plumber comes in and forgets to, put a fitting on that then results in you having $40,000 in damage, that's, in theory, a claim against him, not a claim against you. And you don't want to ding your insurance for that. You want him to pay for it. That way, right? That way you're kind of protecting yourself where, all the people that are working on your property aren't making claims against you. They're dealing with their own insurance company. Another big thing for landlords is making sure your renters get insurance. So that there's the liability portion, again, of each one of these policies. So if they have, something that happens that you would get sued for, but it's really on them, if they don't have the policy, we see in lots of lawsuits, they throw it at the wall and see who sticks. Well, if you can establish the liability and they have the protection, then it's not coming after you. So that's, I've always had this in the first lease that I ever signed. They said, if you want to live here, you got to prove that you have $100,000 minimum of liability coverage on your renters. And if you don't have it, by day 28 or whatever it is, we'll just send it out and get a policy for you and add it to your lease.
Yeah.
The other part of the renters part of it is that your policy doesn't protect their stuff. Big miscommunication. I have this discussion with people who rent all the time is your landlord isn't responsible. Not only not responsible, they don't have what's called insurable interest in your stuff. So even if they wanted to be nice, their insurance policy will not cover your TVs, your couches, your clothes, your books, all your laptop. So most renters think, oh, I don't have any stuff, I'm just renting. But just electronics is a lot of money. Just the ability, and the reality is, unfortunately, especially for people that are renting, and if it's in a high rent area and they're in school or they're just starting off at a job, people don't necessarily have, unlike investors, that's part of their math, right? You don't have reserves for, contingencies and stuff. So the reality is across the country, most people don't have $1,000 to cover an emergency if it comes up. It's unfortunate. A lot of that is due to lack of financial education or, inflation not keeping up with, jobs not keeping up with where inflation's at. So everything is costing people more money and they just don't have extra money to put away. But right, people don't have the money on hand. So while they're sitting there thinking like, oh, I don't want to pay for renter's insurance because I don't have enough money to pay for all this other stuff. And I'm glad I got the apartment. If something did happen to their stuff, their landlord's not paying for it. No one else is paying for it. They have to now restart their life and they don't have anything to pay for it with. Whereas if they had the policy, they could have coverage that would put them up if it was a covered claim. So, if they had to go stay somewhere while the thing was being renovated, their policy would cover it. If all their stuff, burned up, let's even pretend that it was the unit downstairs that caught on fire and then went to theirs and it wasn't the person downstairs' fault. Whatever it was an electrical short. They need to be able to buy new clothes and buy new furniture. Like their policy could cover all of that. Now, whether on the back end it gets in subrogation with the landlord's policy or not, that's irrelevant. The same in the other direction, if a tenant started something and you could possibly have your insurance carrier subrogate it back from the renter's policy, all these things are just set up so that no one is blaming each other and so that everybody kind of has something to stand on if something came up. And so a lot of these policies will, a lot of the landlord policies will ask, do you require your tenants to carry renter's insurance? Now, it won't necessarily be a knockout question, but they're basically trying to gauge, like, are you protecting yourself from headaches and having the ability to have us subrogate their insurer if they're really liable for something that happens? Because then you're not getting dinged with this claim when he was just sitting there throwing matches.
Yeah. Yeah, I think a lot of the intricacies, within insurance is definitely fascinating and really important when we talk about protecting yourself against risk, right? Because um, it's just one of those things where you just don't want to deal with the headaches, and not a lot of people know the depth behind some of these policies, and they think, well, my building coverage or my general liability coverage, which is, cover everything, but your goal should be to insulate yourself as much as possible. And to your point of just having the tenant insurance as well, renter's insurance is something that we do wholeheartedly.
Right.
Because the more and more insurance that we can have in front of us that would not, create some sort of claim on our end is the best position to be in, 100%.
Yeah, and there are even companies. I know there are companies that have it set up where you can offer it to them, and then it's written through someone who holds the master policy for all the tenants in the building, and then you can add it onto your lease, and then part of that becomes an extra revenue stream. I mean, there are creative ways that you can do it, but the reality is you want to kind of have everybody, and you want to have a savvy tenant. You want to have someone that has, again, skin in the game and cares about your property, because you hear these horror stories. I had a client who had a single family rental downtown, and again, it could have been a COVID thing that turned into a mental health issue, whatever it was. But then she was due on rent and whatever it was, and she was getting evicted. And I mean, I saw the pictures. This person left her house covered in human uh
Yeah, feces.
human stuff, human feces, animal feces. I mean, up and down the walls. She poured stuff down the vet. I mean, it's crazy, but like, you don't want to have to deal with that.
Yeah, yeah, and there's certainly professional tenants out there that
Yes.
that know the laws and know exactly what to do, and you'll be surprised how many tenants are professional tenants that know exactly how to bypass different
Uh,
laws and just out for, quite frankly, ill intent. So
So here's a perfect, that segues perfectly into this story. So some of the other coverages you can have besides the obvious ones, especially if you have property managers or other employees, a big one is to have EPLI, which is employer's professional liability, which basically covers you against, discrimination claims is a big one, but there are a lot of different ways that can come about. And we actually had a property management group, fairly large group. I think they have a couple thousand units under management that had a claim. They were looking to get a policy because they actually had the included EPLI on their landlord's policy thrown out because they had too many claims against it. And they found out that this one lady was a serial claimant. She would come in, get hired by a property management group. 6 months in, she'd get promoted and then complain that they didn't give her as much money because, her gender, or because her racial group, or because whatever, all these different things. And they'd basically pay with her from this policy. They'd pay to settle for her to withdraw the claim. Well, they eventually found out that she had done this to multiple property management groups. It's a good racket if you can get it, but it's driving up your costs. It's driving up everyone else's costs because all these companies are paying out, and she's just laughing all the way to the bank until someone finds a way to make it illegal. In other words, she's playing loopholes. Is
yeah,
basically what it is. Like, how do you establish that someone doesn't feel discriminated against? You can't.
yeah,
And you don't want to be the bad guy who does that either. So you kind of just let it go. And she knows that. So she can just, why that doesn't come up when you're interviewing someone is a different question. But again, they're not necessarily talking to each other, A, as competitors, and B, because you don't want to be embarrassed as the only person who got nailed. So you're just like, oh, well, it happened. We're not going to warn everyone else.
yeah,
Because sometimes you can get lucky and find out that someone's a disaster of a tenant or and you don't have to have it come from a place of them having a discrimination claim. You can just be like, we decided to go another direction, and not give them any information that they can twist. Because the second they have a way to put a spin on it, it's just going to end up being a headache.
yeah, yeah. It's one of the things that people don't really talk about, the headaches that can come about, when um, in this business. But definitely finding someone who is professional like yourself and knows the ins and outs of the industry is a great way to insulate yourself from risk. So Ben, if our listeners want to follow you, learn more about your company and how they can get more feedback on insurance policies, what's the best way for our audience to stay in touch with you or get in contact with you?
Yeah. So the easiest way is I'm on LinkedIn. I put up fairly interesting stuff, I hope, fairly often. Ben Guttman. I should be easy to find. I kind of look like myself without the beard. I put that on because it was cold. We'll see if I keep it or not. Usually it comes off for the summer. Um, but yeah, it's my name, Ben Guttman. I should be easy to find on there. Same company, North Central Insurance. Um, we're on Facebook. We're on, I'm all over the place. But I mean, yeah, you can shoot me an email. You can call me. All my contact information is in my profile on LinkedIn. That's usually the easiest way to find me, because I'm usually talking to people there, a lot of the day, especially when you're dealing with people that are involved with the transaction that I'm talking to, that are on there. They're on there talking to their clients, and then we'll have mutual clients that we're talking about. So I'll be talking to the lender, and I'll be talking to an inspector, and so as much fun it is to sit in your email inbox all day, it'll drive you nuts. This way, at least you're kind of keeping up with your clients and what's going on out there all day.
Super cool. Super cool.
Yeah.
All right. So Ben, thank you so much for being a guest on our show today. I mean, we talked about insurance, the importance of getting in contact with, your insurance broker on what to put on your property as quickly as possible. All of the ways that you can protect yourself as an owner. So thank you so much for being a guest on our show. Thank you to our listeners for tuning into another episode of the
I
Mogul
just want to throw in
Marathon.
one thing that you mentioned to me before we get off. You wanted to bring up prop tech a little bit. So we
Yeah.
kind of touched on it with the vacants, but there are a lot of devices out there that you can use now, and it will come up on almost all applications, whether it's cameras or water sensors. Water sensors are a big one, especially in properties where you're not necessarily going to know that there's a leak. And a lot of times the carriers will have a prearranged discount to get them installed, because they have a vested interest in not paying a larger claim, and you have a vested interest in your property not being underwater. And especially now when everything's freezing over, it's a great time to think about it. But you brought it up, so I wanted to make sure that we talked about it. Definitely, I think, you see it on auto insurance where they already are rewarding you for, driving responsibly, not speeding, not, doing all this crazy stuff where they'll let you track it. In a similar vein, if you're making sure that it can have an automatic shut off on the water, or if, making sure your smoke detectors actually get inspected and don't have dead batteries in them. There's nothing more frustrating than having smoke detectors in a building that haven't had a battery that worked in years, because then it's like, well, we could have prevented this whole thing.
Yeah.
But sprinklers is a big one, especially when it gets to multifamily buildings. It is on every application, and it is a big knockout for a lot of places that want more updated buildings. Anytime you update one of the big four systems, if you're dealing with, the roof, the plumbing, the electrical, the heat, any of that stuff, that's a win for underwriting. They want to see that it has less opportunity for something to get messed up. They love things that have updated systems, but it just, sprinklers, especially in the past year or so, have become so much more crucial. And again, back to tying it all into your codes discussion from before, anything built after a certain date, in Baltimore City, Baltimore County has to have them. Like, I know I've been in, single family homes that have them just because they were built after that was code. So that is a drawback with some of these B and C properties, that it wasn't required then. Whether you put them in or not, kind of limits some of your options in terms of companies when you get down into the nitty gritty, because, they really are looking for properties that have that in there. But yeah, definitely the water sensors has become a huge thing recently, both from an insurer standpoint, because they're willing to almost split the investment with you, as well as from just like time of year, and everyone's having pipe issues.
Yeah. I think prop tech on, to your point on insurance is something that's extremely fascinating from a risk perspective and then also asset management perspective. I mean, you brought up the point of a leak. It's one of those things. Water is one of the things that I think from a property damage perspective is probably the most curable, but the most expensive if you don't catch it
Right.
early on, right? And just being able to track a leak as quickly as possible before it becomes a $10,000 repair. Something as simple as just changing a valve is something that maybe costs you like $100 compared to paying $10,000 because now you have a huge leak that you didn't catch. So I think prop tech and the emergence of that, when we talk about technology and real estate and the Internet of Things being connected within each other, is something that I think is going to transform the industry over time and be extremely beneficial to owners on how they operate and manage and de-risk these assets.
Yeah, you just got to make sure that no one can hack into it. But that's cyber, and that's a whole that's tomorrow's topic on a different podcast. But that the Internet of Things stuff, I mean, the amount of things that people can get into, not that they do necessarily, but we're just starting to see where it could happen. Where like, hey, we're just going to turn off all the electrical here. Well, that's not okay when it's -5 outside, or we're just gonna, tell the water system that it just wants to keep running. Like, so there's a lot of, like you were talking about, there's a lot of room for people with malicious intent to mess with stuff. And again, we for all the advantages that you have with that, there's also, you got to protect yourself on the back end from it. Sorry to put a damper on it, but
Yeah, no, totally. I mean, you're definitely bringing up a good point. When you're connecting things to the internet, there's an additional risk to that as well with someone hacking and taking
yeah,
advantage of it. So, man, Ben, we talked. I'm really glad we got an opportunity to share with our audience. The frameworks of putting the right insurance on your properties, and we just touched on prop tech and all of the things that investors should be paying attention to when they're placing premiums on these properties. So thanks so much for being a guest on our show. Thank you to our listeners for tuning in to another episode of the Mogul Marathon Real Estate Podcast. Let's take action, be great today, and remember that real estate is a marathon, not a sprint. So run your own race. Thanks again, Ben.
thanks. Have a good one. Happy New Year, everybody.